Welcome back to Ben's Book Club. Today we are diving into the book Insane Wealth by Design, 8 Rules for Smarter Investing and Financial Freedom. This incredible guide by experienced financial planner Stuart Wemyss completely flips the script on how we think about building long-term wealth. Wemyss has actually spent over 25 years advising clients, and in this explainer, we're going to unpack his evidence-based approach to making fewer but significantly better financial decisions. Now, we aren't looking at any kind of get-rich-quick schemes today, right? We are looking at designing a foolproof system that actually survives human emotion. Because, as Wemyss points out, the absolute biggest threat to your wealth isn't the stock market, it's not inflation, and it's not the economy. It is literally your own psychology. So we're going to explore his 8 disciplines as a highly practical operating system for building real long-term wealth.
So let's start by targeting a very specific and honestly really widespread problem. It's the high earner, poor investor phenomenon. You know the type, right? So many people make incredibly good money for 20 or 30 years, yet they arrive at retirement with surprisingly little to show for it. And why does this happen? Well, it's because of what Wemyss calls the leaky bucket. Your surplus cash just vanishes into lifestyle creep. Think about it. You get a 10% raise, so you decide to lease a slightly nicer car. You get a solid year-end bonus, and suddenly you're upgrading to luxury vacations or maybe buying expensive watches. The money comes in, sure, but it flows right back out. Without a highly structured plan in place, all that extra income just leaks away long before it ever has the chance to be invested and actually work for you.
To fix this leak permanently, Wemyss introduces this evidence-based wealth operating system. The core of the system is this really simple, undeniable formula. Wealth equals cash flow surplus, multiplied by investment efficiency, multiplied by time. I love this because it mathematically proves that wealth isn't about blind luck, and it certainly isn't about chasing hot stock tips on social media or trying to time the market perfectly. It's a repeatable framework based entirely on factors you can actively control. You control your surplus by intentionally managing your lifestyle expenses. You control how efficiently you invest that surplus through financial education and discipline. And most importantly, you control time by deciding to start today, right now, rather than waiting for some imaginary perfect moment in the future. In this explainer, we will break down Wemyss's 8 rules into 4 distinct, logical pillars to build your ultimate wealth system. Number 1, mindset and income goals. Number 2, the core wealth engines. Number 3, tactical asset allocation. And number 4, protecting your financial blueprint. Okay, let's start building our foundation with pillar 1, mindset and income goals. Rule 1 demands a massive, fundamental shift in how you view time. You have to think in decades, not days. The foundation of this entire operating system requires you to actively ignore the daily financial news. You have to tune out the short-term market noise and completely bypass that panic-inducing social media hype. When the news cycle freaks out over a temporary market dip or a slight interest rate fluctuation, you literally have to ignore it. Real wealth is built slowly and then suddenly. But that explosion of wealth only happens if you stay in the game long enough to let compounding do its heavy lifting. You've got to rely on the calm certainty of long-term planning, rather than giving in to the anxiety of daily market fluctuations that ultimately just don't matter over a 20-year horizon. For Rule 2, you must define your exact enough number and your timeline. A lot of people just had this vague, fuzzy notion of wanting to be comfortable or maybe secure when they retire. But Wemyss argues, and he's totally right here, that you cannot possibly design a path to financial freedom if you don't actually know your specific destination. You need a hard dollar figure and a specific target date. Is it $2 million by age 55? Is it $5 million by age 60? Once you know exactly how much passive income you need and by when, it completely clarifies your goals. It removes all the guesswork and drives much smarter, more deliberate financial decisions today. It allows you to work backwards and figure out exactly what you need to save each month.
Moving right along to pillar 2, the core wealth engines.
Rule 3 is where we finally plug that leaky bucket we talked about earlier. You need to build a savings engine that runs on autopilot. Here is the absolute hard truth of personal finance. Willpower is a terrible strategy. Discretion is the enemy of saving. If saving money is an optional decision that you have to actively make every single month, human nature guarantees that eventually you're going to fail. You'll have a bad day, or you'll see something shiny and you'll spend it. You absolutely must automate your investments. By setting up automatic transfers the very day your paycheck hits your account, moving funds directly into your investment portfolio, you completely remove human emotion and friction from the equation. The money is invested before you even have a chance to miss it. Rule 4 dictates a life cycle approach to investing. Look, you shouldn't use the exact same strategy for your entire life. Early in your journey during step 1, you must prioritize accumulating capital growth assets to build your base. This is when you want your money working its hardest to multiply. Then, in step 2, as you get closer to that enough number we defined earlier, you begin to introduce liquidity into your portfolio. Finally, in step 3, you actively reduce your gearing, which simply means lowering your debt levels. You effectively transition from an aggressive growth phase into a highly defensive, liquid, and secure structure as you near your finish line, locking in all the wealth you've spent decades building.
All right, let's dive into Pillar 3, tactical asset allocation. Rule 5 tells us to adopt a value-aware asset allocation. Rather than blindly following static models, like a rigid 60-40 portfolio that literally never changes, you should build a portfolio that is constantly mindful of underlying valuations. The reality is, not all asset classes are created equal at any given moment in the market cycle. The goal here is to be deliberate and intensely aware of fundamental values. This ensures you actively avoid buying into overhyped asset classes just because they happen to be popular right now, which is a really common trap for investors relying on rigid, set-and-forget portfolios. Being value-aware means buying assets when they make fundamental sense, not just when they are trending.
For Rule 6, Wemyss shows us the stark contrast between two very different approaches to the share market. Trying to pick winning stocks to somehow beat the market is a massive emotional trap that usually ends in severe underperformance. Chasing the next big tech stock or some revolutionary startup feels incredibly exciting in the moment, sure, but the evidence, backed by decades of rigorous academic studies and undeniable market data, strictly favors low-cost, rules-based index funds. Evidence-based indexing captures broad market returns highly efficiently, it strips away the hefty fees of active managers, and honestly, most importantly, it removes the dangerous human temptation to speculate on unproven companies. Rule 7 dictates how to handle real estate, and Wemyss is famously strict about this one. You should only buy property that passes 3 non-negotiable filters. First, enduring demand. Will people always want to live in this specific street or suburb? Second, scarce supply. Is it literally impossible for developers to just buy a block down the road and build more of it? And third, growing demand. Is the broader economy and population naturally pushing toward this area? Because of these filters, Wemyss insists you must absolutely avoid generic new builds, house and land packages on the city fringes, or high-rise apartments. They severely lack intrinsic scarcity. You want investment-grade properties, where the land value itself drives the long-term growth, because they simply cannot create more land in highly established, desirable neighborhoods.
And finally, we arrive at Pillar 4, protecting your financial blueprint.
Rule 8 warns us that a great offense means absolutely nothing if you don't have a rock-solid defense in place. You must remove as much risk as possible from your life. Protecting your wealth involves a balanced mix of comprehensive insurance, intelligent asset diversification, and correct legal structuring, things like using family trusts and maximizing your superannuation or retirement accounts. It is truly tragic how many people spend decades successfully building their wealth, making all the right moves, only to lose massive chunks of it because they overlooked basic foundational protections. You have to actively ensure that a single bad event, whether that's an unexpected illness, a frivolous lawsuit, or a severe market crash, doesn't permanently wipe out a decade of your hard work. This quote from financial journalist James Kirby perfectly summarizes why this framework is just so vital. This book is exactly what we need right now in an era of constant financial distraction and overwhelming noise. The 8 disciplines give us an operating system that fundamentally outsmarts our worst instincts. It completely takes the emotion, the dangerous guesswork, and all the chaos right out of investing. It replaces all of that anxiety with a clear, reliable, mathematical blueprint for enduring financial freedom. Because ultimately, this isn't just about accumulating money for the sake of having money. It is about building a life entirely free from financial stress, allowing you to focus on what actually matters to you. So I leave you with this pivotal question to start designing your own wealth. What is your exact enough number? And what is stopping you from automating your savings engine today? Take the time this week to calculate that target, figure out the math, and put your investment systems on permanent autopilot. Thanks for joining me for this explainer, and be sure to subscribe so you don't miss an episode.